Welcome to a new topic on the cost of capital for companies. In this introductory lesson, we'll revise on the weighted average cost of capital, followed by the top-down and bottom-up factors that affect the cost of capital. Let's get started. The capital components of a firm usually consist of debt and equity, and sometimes preferred stock as well. For this lesson, our assumption is that the company has no intention to issue preferred stock, so the capital structure is simply debt plus equity. Let's denote RD as the before-tax cost of debt. This is the rate at which the firm needs to pay when it wants to issue new debt. And RE is the cost of equity. It's the required return on the firm's common stock. The weighted average cost of capital of the firm, or WACC, is the sum of the weight of each component multiplied by their respective rates. The weight can be simply calculated based on the market value of the company's debt and equity. However, if the market value weights differ substantially from the company's target capital structure, it's better to use the weights based on the target capital structure. This is because the target weights will better reflect the capital structure of the firm going forward. Also, do note that in many countries, the interest paid on corporate debt is tax deductible. As such, the actual cost of the debt to the firm is reduced by the tax savings from the interest paid. This is the reason why we adjust the cost of debt for the firm's marginal tax rate by multiplying by this term 1 minus T. This gives us the after-tax cost of debt. Take note that this adjustment only applies to companies in jurisdictions that allow interest payments to be tax deductible. Perhaps some numbers may help you understand better. If a company has $10 million debt and pays 10% interest on it, the total interest paid each year is $1 million. However, this $1 million is tax deductible, so if the marginal tax rate is 30%, the company will pay $300 less taxes. So in aggregate, the after-tax cost of debt to the company is $700,000, which is 7% of the outstanding debt. If you take 10% multiplied by 1 minus 0.3, you get the same figure. That is why we multiply the cost of debt by 1 minus T. Take note that this tax deductible only applies to interest paid on a company's debt. Dividends to stockholders do not have such treatment, so we do not make the tax adjustments. The cost of capital of a company is a function of its cost of debt and cost of equity. The factors that affect these costs can be seen from a top-down approach and bottom-up approach. The top-down factors are the external or macro factors. These factors affect the credit spread of bond markets and equity risk premium in the stock market, which will trickle down to affect the cost of debt and cost of equity for individual companies. The general availability of capital in the economy is one major top-down factor. Greater capital availability typically leads to more competition for corporate debt and equity issuance and consequently lower associated costs of capital. Developed economies typically have more established and liquid stock and bond markets with greater capital availability, more stable currencies, and better investor protection than those of developing economies. Consequently, the perceived risk is lower, which translates into lower credit spread and ERPs for companies that raise capital in developed economies. In less developed capital markets, availability of capital is tight, so companies may rely on other sources for funding, such as the shadow banking system, which are less regulated and of higher cost. A company's cost of capital is also highly influenced by market conditions, such as interest rates, inflation rates, and the macroeconomic environment. The credit spreads and ERPs reflect overall credit and equity market conditions. A decrease in expected inflation lowers sovereign bond yields, that is, the risk-free rate is lower, thus lowering the cost of capital for companies. In a strong economy, investors are more willing to take risk, so credit spreads narrow and equity risk premium decreases. And monetary policy of the central bank that lower benchmark interest rates decreases the risk-free rate. The available of cheaper credit also means lower credit spreads and equity risk premiums. In developed economies, more predictable and transparent monetary policy contributes to greater certainty and lower volatility in interest rates and inflation rates, reducing market risk and thus lowers the market credit spread and ERP. Next, the legal and regulatory considerations. Empirical evidence suggests countries that have a common law legal system offer stronger protection to investors, leading to lower market risk premiums as compared to countries that follow civil law systems. Some industries are more highly regulated. Their costs of capital are influenced by regulatory policies and guidelines set by the government or other related entities, which can drive key financial decisions such as those related to capital structure, payout policy, and pricing. And lastly, the tax jurisdiction. This is obvious, as the higher the corporate tax rate, the greater the tax shield, so companies would prefer to raise debt capital over equity capital. The bottom-up factors are company-specific factors. A company's cost of capital should reflect the level of risk in the expected cash flows. First, the volatility in revenues, earnings, and cash flow. Obviously, the lower the volatility of earnings, the lower the perceived risk of the company, so the cost of capital is lower. Non-cyclical businesses such as utilities and consumer staples tend to have stable revenues, which translate to stable earnings and cash flow. They're often less risky than cyclical businesses with more volatile revenues. Besides, companies that have a large pool of potential customers face lower customer concentration risk, resulting in lower earnings volatility. Lower levels of operating and/or financial leverage also decreases the volatility of earnings and cash flows. Besides earnings and cash flows, investors may also consider more qualitative aspects of the company. Companies with better corporate governance, as well as companies with favorable ESG practices, may convince investors to accept lower risk premiums. The nature and liquidity of the company's asset can also influence investors' perception of the company's specific risk, particularly to debt investors. Some of the company's assets are used as collateral for its debt, so the creditors may demand less of a premium when the collaterals are of good quality. That is, they have high recovery values in the event of a liquidation. In general, assets that are tangible and non-specialized are preferred over intangibles and specialized assets like goodwill. This is because the tangible and non-specialized assets have a more ready market of buyers in the event of liquidation. Assets specifically designated as collateral reduce the cost of secured debt, but increase the cost of other subordinated unsecured debt as their claim becomes inferior. The financial strength, profitability, and leverage of the company is another bottom-up factor. Simply, companies that are more profitable have higher ability to generate cash, and lower leverage have a lower probability of default. Investors will accept a lower risk premium for both its debt and equity. Leverage ratios such as debt to equity, debt to EBITDA, and interest coverage ratios are often used common metrics to assess the financial risk of companies. And lastly, security features, that is, in reference to the embedded features that protect either the investors or the issuers. Embedded call options protect the issuer at the expense of investors. Investors are vulnerable if interest rates decrease, such that the issuer chooses to call back the bonds to refinance at lower rates. Investors demand a higher risk premium for callable bonds. Conversely, an embedded put option benefits the investors as it allows them to put back the bond to issuer in a rising interest rate environment. The investors should demand a lower risk premium, that is, the issuer pays a lower interest cost. A convertible bond benefits investors as it gives them the option to convert the bond into shares when the conditions are favorable. Investors will accept a lower rate of return for such a feature. Stocks-wise, a preferred stock is one where the company promises to pay a fixed dividend every year, unless it is an unprofitable year. Preferred stock with a cumulative feature are required to accumulate such missed dividends, such that the cumulative amount is to be paid when the company is able to. Such cumulative preferred stock should have a lower risk premium than equivalent non-cumulative ones. And lastly, some special class of common stock may provide different cash flow or voting rights. The cost of equity for stocks with higher voting rights may be lower. And that concludes this introductory lesson on the cost of capital for a company and the factors that influence the cost of capital. In the following lessons, we shall examine how to estimate the cost of debt and the cost of equity. See you again.